Good morning, everyone. So I know it's a little quiet, but what we have done is because this is our very first webinar. Actually, first, let me introduce myself. My name is Natasha, and I am the Affiliate Marketing Coordinator here at WealthyPlanet. So this is our very first webinar that we have open to the general public, which is very exciting. But because this is something we've never done before, we're using a little bit of a moderator system. So you are not able to see other participants, nor are you unable to mute yourself, but you are able to message me directly and I will forward those questions over to John. So if you have any comments, questions, concerns that pop up during the meeting, I am your voice that I'll be sharing with that. And just because the internet can be a big and scary place sometimes, you're never sure what to expect. So this is how we're testing those waters. So if you guys want to try sending me something in a direct message now, that would be a great time. Even just an emoji telling me how your day is, that would be phenomenal. I've got silence in the chat. Hey, oh, they all came through at once. Hi, hello. Hello, Laith. Hello, Vicky. Thank you. And a big smiley face emoji. I love emojis. We've got tons coming in. This is awesome, guys. Thank you so much. So we've just waiting for a few more people to come in. Let me just check check on our waiting room here. All right, looks like we are just about ready to go. Hi, Mugi, thank you for joining. Oh, we've got another person coming in here. Hi, Yuki, you can't see the comments of any other people either. Is that on purpose? Yes, because this is our first time running a webinar that is completely open to the public. We are using a moderated system just because we're not really sure what to expect. So this is our first time doing this. So thank you for being aboard with us. We're really excited to share the knowledge that we have with the general public. But no, you won't be able to see the comments of other people. I will be sharing them with the group. Just as a trial run, we figured this was the best way to minimize chaos for our very first webinar that we're sharing with the general public. But if you have any questions at all, please put them in the chat. I will be sharing them with the group and John. Awesome. Okay, sounds like we're affirmative on that. All right, and John, you think we're ready to go?
Okay, I'm ready if you're ready.
Okay. Then without further ado, ladies and gentlemen, I would love to introduce you to John R. Podlewski, our CEO and founder, who will be leading us through this webinar today. Take it away, John.
Okay, thank you, Natasha. Well, hello, everybody. Sorry that I'm an old fart and you don't get to see one of these more younger and more handsome looking individuals speaking with you today, but I do have 30 years plus experience in the industry. And I think I'm pretty relatable as I'm going to talk in real general terms today about the plight of what's about to happen moving forward with inflation and just the overall industry as a whole. And I'm going to begin by telling you that I left the military after a 10-year career with the Canadian Armed Forces, and I entered into financial services by way of being taken advantage of by an insurance company. So I was a young man with a young family, and I was about to be deployed. And so I thought I would buy some insurance, and a guy came to my home, sat on my kitchen table and pitched me his pitch and asked me what, my goals were. And at that time was buying a home. And he told me that everything would be fine for one monthly check, about $225. And when it came time to buying that home, and I called that company, which by the way is no longer solvent, the person on the other end of the phone said, we can take care of you, Mr. Podlewski. What would you like? And I said, I'd like to pull out $40,000 out of my policy and pay for my first home in Calgary, Alberta at that time. And they said, you don't have any savings. I go, how is that even possible? I've been paying $225 per year for all these years. And, I'm looking at your sales sheets right here. And they said, are you looking at the legal binding contract? And I was like, well, I'm looking at what your agent highlighted all over and what I bought on. And she says, well, can you read the very bottom of those sheets? And it's like it happened a minute ago. For illustrative purposes only, Future value is not guaranteed. No reflection of earnings nor future earnings. Basically, not worth toilet paper. And, this was a time where Google was not around. The internet was not, as proficient as it is today. And so in order to learn anything, I had to go to an actual library. I pulled out every third-party legitimate consumerist book on finance and realized that there was a lot of simple stuff out there. So our goal as a company is different. Our goal as a company is about literacy, it's about teaching, it's about educating. I know most of us, all right, unless you're a postgraduate and you went that line academia, probably haven't worked with mathematics since maybe grade 12 or the last time you were mandated to work with mathematics. And so we want you to know that, making financial decisions, if you're given all the information, is actually pretty simple. The issue that we face as consumers is the rhetoric in the industry, is the being taken advantage of by companies who know that you don't know and are not willing to share true mathematics with you. And so products have been created to take advantage of you as consumers. They understand, right, that the long-term planning, right, is not understood by the majority of people today. And so they use those as leverages and fears to make you do things that you aren't looking at from a long-term perspective in your life. And so I'm just going to touch on the silos of financial planning today, as we're going to follow up with more detailed webinars as we move forward. But I wanted to get you involved in a feeling of what WealthyPlanet is, how we take a stand for consumers. And we created our company. If you make $50,000 a year or you make $5 million a year, our platform was designed with mathematics first and foremost. We are not by any means commission-based as a company. We are 100% salary-based. And so you never have to worry about the information we're sharing with you. And if you want to know where we get a lot of our information, we're going to state it as we go through, and we'd be happy to send you, where we get a lot of what we talk about. So just think of us as a true, if you will, company that's taking a stand for you, that's here to teach you. And then, like Miracle on 34th Street or whatever that great Christmas show is, if you want to take the information that we're going to share with you and you want to go back and fight for yourself at your institution, you're more than willing to do that. We've created a better mathematical mousetrap that we're going to share with you today, and the why. And so we understand that, we're fighting the big institutions out there, but we feel that we have a unique, if you will, and I hate to use that word, but we're armed better than they are, and we're able to fight them in a guerrilla setting until we grow as big as those banks. And we'll do it by people talking about us because, much like in a Jenny Craig fashion, if you will, in the weight loss world, we're able to say mathematically, here's your life, here's your decisions, here's what they sold you on, here's the mathematics, and here's how much better your life can be. And just based on saying, hey, look, I want to go from A to B, right? That's as much as we do as a company. And then we follow suit with ensuring, right, that non-commission-based products are put into place so that not only your plan is mathematical, but you have matching products. So let's begin by talking about the problems facing our country right now. And these statistics, they're coming in from, Stats Canada. They come from the Institute of the Value Institute of the Family. So we could have the next slide, please.
Absolutely. Just wanted to give a quick welcome to the couple of late people that came in while John was speaking. So what is happening is we are running with a moderated system. So you are unable to message the group directly. However, you are able to message me, and I'll be happy to pass along any comments, questions, or concerns throughout the discussion. Thank you so much. And here's your next slide, John.
Thank you. So we're going to talk a little bit about the problems surrounding Canadians. We're going to break down from a high level some of the silos out there. We're going to talk about the banks. We're talking about wealth management companies. We're going to be talking about insurance companies. We'll talk about debt specifically because it is a keen factor in personal finance. We're going to talk about, a product that is changing the entire insurance industry as we speak, a little bit about wealth management, and then financial planning is an overall spectrum. And again, very high level, kind of like a fireside chat. I'm not going to get into too deep on the mathematics. If that's who you are, no problem. You can book a follow-up appointment and we'll be happy to share to you what a 6 million cell spreadsheet looks like. With every bit of tax optimization, consumption smoothing, Nobel-winning mathematics. We can go through all that stuff one-on-one if that's important, but I wanted to speak to the masses today because, our next slide is, you're probably in a scenario that at least one of these problems you're facing as a Canadian consumer right now. Next, please. So, this is we say that the top 1% of Canadians get proper financial planning, leaving the average Canadian with these issues at hand. And look, I'm going to be, specifically grinding it out here. If you want to get a 1% financial plan, you can go to like big companies out there. The major banks have their own major brokerages in the wealth management area. Some of them you need a minimum of $2 million to get involved with them. Not going to happen for your average Canadian, but I want you to know that they just do the wealth management for the most part. The actual planning side isn't done. They'll spin you off to a specialist in those areas, even if you've got $2 million in liquidity and you want to do that. But they won't talk about the stuff we're going to talk about. And you're going to have to pay more money outside of their wealth management costs if they send you to a tax attorney or they send you somewhere to look at these things. And it's all about the money grab. They're involved with each other. They refer each other, but enough in that. Let's talk about insolvency, okay? So the nation's top financial priority is paying down debt. It's about to get buku worse. Here's why. Yesterday, the feds just jumped the prime rate by 25 basis points. And that doesn't sound a lot, but listen, if you're holding a $100,000 mortgage, that's an extra $250 a month you're paying, right? Principal and interest. If the average mortgage today in place is $500,000, that seems to be about the mean average across the country. You now have to find $1,250 of additional revenue in your household to pay that down as you move forward. Well, right now we spend $1.74 for every dollar earned, and that fluctuates between 3 and 5 cents, every time we find a new statistic. So, we're taking this one for the Value Institute of the Family. So where are we going to get this other $1,250? More importantly, people, 35% of the mortgage industry is what we call subprime. And these are hardworking Canadian families who weren't able to go to the bank and get a rate there. They had to go to private mortgages, or what we call B mortgages. And it could be because they didn't have the 25% down, or it could be the fact that they were self-employed and the way they were working the last few years and maybe COVID weren't able to go to the banks, and they had to go to where they pay higher interest rates. People, that is 35% of the entire mortgage marketplace that could be upside down moving forward, right? And we have to be fearful of this. Why? Because it's not CMHC insured, and it could go down the same, if you will, rabbit hole that the Americans went through a short, 10 plus years ago. And, and we look at uncertainty. 73% of the country is worried about saving enough for retirement. And I'll tell you why. It's because they're overwhelmed. When a financial planner comes to your home, they talk at a high level. They use, jargon-based industry stuff at you. We're all proud people. Nobody wants to sound right that they don't know. Normally big companies, big brands, big commercials, big sponsorship, and everybody goes, oh, almighty banks, or oh, almighty insurance companies, oh, almighty wealth management. We'll listen to you, right? Because we're just a little guy. And it's wrong, right? People should be breaking it down and teaching it to us at our levels so that everybody can understand, their entire life moving forward. My point is simply this. If you are going to work your entire life for money, you require money to work for you. Let me say that again. You will spend more time in your life out there making money than you will raising your kids, going to sleep, or what. So my point is this, right? If they have us focused that way, then we have to fight as consumers for every bit of interest in savings, every bit of interest on growth, right? And ensuring that we take care of our households, right? And not allow people just to speak over top of us and put us in things because of fear or confusion or anything like that. And then finally, my last tick here is we're underinsured. The average death claim out there in Canada these last few years has been under $350,000. And so what that's supposed to do with a family or a single mom or somebody with liabilities, it's ridiculous. And because I came in this industry, having been literally screwed, I know it's a bad word to use, but the other word was even worse, by an insurance company. And that's what I started my conversation with. I hold this one very close to my heart. Having been an executive over the last 30 years, I've had to pay 9 death claims. One was a personal client of mine. The other 8 came from people of industry who quit and left me holding the bag. And not one was mathematically solvent. And even though we were at that time term insurance advocates, there still is not enough opportunity for people to get proper insurance in place. Why is this a big deal? Well, if you bought your first house, I know you've got fire insurance. I know you've got insurance. So you lose that house, it's going to be replaced. If you're driving a late model car, I know you've got insurance to replace that car. You know, if you're renting, you don't have it, right? If you drive a piece of crap that's 15 years old, you don't have that type of coverage. You just have collision. So my point is, if you're a breadwinner and you have liabilities, then you need to be covered. Simple as that. And we'll touch that moving forward. Natasha, if we have a question, I'd be happy to answer one. If not, let's move to the next slide.
Sorry about that. Yes, we did have a question come in. Thank you for paying attention to my note. So while you were speaking about being overwhelmed in other financial planning institutions, we had one participant ask, what makes us different?
Well, you know what? That's a one-word answer and I love it because it can't be challenged, and it's part of our next slide. We are completely and utterly mathematical, right? And so here's what I love about math. Math doesn't lie. Math is truth. Simple as that. I don't care if you look at the mathematics involved in gravity. I don't care if you look at the mathematics involved into the tidal, side of the world, right? And the gravitation pull for the moon. It doesn't matter. Math will not lie to you. Salespeople will, though, because they're incentivized on a commission-based world to sell certain products, and those products are designed via distribution to make those people money and those companies money. So let's actually have the next slide, and I think I can tie this in quite well. So we have taken on Dr. Moishe Milevsky's book, which is co-authored with two other PhDs here in Canada. Both other PhDs are over at McMaster. And of course, Dr. Moishe Milevsky, who is in the top 10 financial personas in the world, is over at the Schulich School of Business at York University. And he co-wrote this postgraduate book for PhDs called Strategic Financial Planning Over the Life Cycle. I'm going to explain it to you very simply. I mean, if you are a calculus freak, you will love this book. I myself didn't get past, chapter 7, but lucky for me, I've got prodigy personalities in this company who are over and above, 160 IQs, and who are able to go through the book, and it inspired our entire financial plan. And so what I love the fact about answering this question is that we are completely irrefutable in the way that we do our financial plans, including the products we put in place. And so that's why we're so empowered, whoever asked that question, to say things like this. In fact, we're looking forward to our national launch where we have compared our mathematics to everything else on the street. And we believe that, for the average person, we can make a minimum, bar none, a minimum of $100,000 difference in your life moving forward. So we're going to bring back the old Pepsi Coach challenge, and we're going to say to people, we're going to give you X if you take the challenge, and to see how much we can help you moving forward. So this is the first complete mathematical and holistic financial plan that handles all aspects of your life. So what do I mean by that? Well, financial planning, the bank works with debt. Financial planning with insurance companies work with insurance products. Financial planning with wealth companies work with wealth products, but nobody has the complete overview of your entire life and prioritizing what's important to you. So goals don't work. Why? Well, I'm still overweight, and I've had a goal the last 3 years, every January, to lose this chunk of weight that I'm fighting with, right? But I want you to know that, I lost a neighbor to a terminal disease a year ago. And that man, like me, did not, get up in the morning and run and do stuff. And now I am. But my point is, the moment he learned he had a medical issue that was terminal, that became a priority, right? That health became a priority. And I'm sure you've seen it in your own lives as people have been touched with cancers or whatever it is. So my point is this: our mathematical perspective is based on your priorities, yours, not the company's. How can we be wrong if we're supplying you the mathematics to what you make as a priority? And you can take that math anywhere you want, and you can use it as a weapon against whoever took advantage of you and say, why didn't you tell me this stuff, if that's what you choose? But that's the kind of position we are, as a company. I think of Braveheart and Mel Gibson running in front of those Scots before they fight tyranny. I think of it the same way. I'm watching the media every day with Ukraine being invaded. We're the guys, right, sticking up for the little people, ensuring that your decisions do not cost you, right, years and years of pain and suffering because it was grabbed by profits of another company. Next, please. Do I have a question that I need to answer before I go anywhere else?
No questions just yet, but we did have a couple of latecomers, so just wanted to welcome them and remind everyone that we are doing a moderated session, so you aren't able to unmute yourselves or interact with the rest of the participants directly, but you are able to send in any of your questions to me, and I'd be happy to have John answer them live. So please don't feel shy.
Okay. All right, let's talk about the almighty banks, right? I mean, for years we've talked about the 6 big ones, but I know there's probably 8 to 10 of them now. And then of course you got your challenge banks out there. But I mean, I just want to make sure we're all on the same page, all right? Banks create debt and profit over your lifetime, right? That is the core essence of banking. It is debt-based. And I'll give you an example quickly. For years and years and years, I used to use the rule of 72 to teach people, right, that you should fight for every point or basis point, right, in your portfolio moving forward in your life. However, now because we spend $1.74 for every dollar that we earn, I'm now teaching it as a debt against you. So in this little, if you will, analogy, we're going to use a one-time $2,000 lump sum. And we're going to use it for 48 years. So basically, right, when you went to college, pretty much to 65. That's about 45 to 48 years. And odds are you'll use a credit card moving forward in your retirement. So, but I want you to look at this. You know, so the rule of 72 is a very large algebraic equation, but it basically states this. If you take the interest rate that you earn or you pay, and you divide the rule in the number 72, what you'll get is a length of time that compounding values of interest that, right, go week on week and month on month and year on year add up and then double, right? So we're saying here that a $2,000 one-time lump sum, you get a 6% interest charge. So that, you know, that's a feasible way to right now. That's people that are in private mortgages, people that are in B lending, a lot of, if you will, if you pull out equity of your home and you do a securitized rate, it's probably between 4 and 6%. So that's out there right now and about to increase as we go through this year. So it says money doubles every 12 years, right? So 2,000, 12 years become 4,000, and 4,000 after 24 years become 8,000. And then you add it up at 48 years, you've got 32,000 interest you have paid against yourself, right? And then here's the thing that we all don't realize as they're taking advantage of us. That's just the interest that we've paid. That's not the lost opportunity had that money actually grown for you in an RSP or a TFSA or buying a home or buying another property or buying some sort of equity that will grow in your life. That's just interest you've paid against your future. And to give you the impact, all right, and what the bank is doing to you over a lifetime, let's take 12%. Well, if you take 12% that same time, that same lump sum, you know, as everyday Canadians, we think, hey, I double my interest, right? You know, I'm going to double, right? No. Now every 6 years it's going, right? So all of a sudden in 6 years, it's gone to 4. In 12 years, it's now at 8, right? And then at another 6 years, right? At 18 years, it's now doubled again. And so by 48 years, you're now paid $512,000 of interest on the same loan. So here's my point, guys, ladies and gents. What are you paying your credit card right now? Like they're issuing credit cards to students of 28, 29% along with your student loan. It's ridiculous. We're a generation that's gone the last 30, 40 years. And, you know, the millennials are the last to go through this. And now the next generation is hitting it. It's like OSAP boy meets OSAP girl. And they fall saply in love. And they join matrimony, right? You know, with their partners of life. And they're holding like what, 200 grand of debt if they end up with a postgraduate degree before they get that 1-bedroom condo, which is like 600-800 grand now if you're in a major city. So, right, that couple $100 grand each of them, and then a condo and a couple Hondas in the driveway. And all of a sudden, right, we've got this is why it's so important that we do this as a company. We got a divorce rate in the millennial statistics right now that 51% in 60 months. The number one issue facing them, financial duress. Thank you, big banks. Thank you for putting us in that position to ruin our lives moving forward. And God knows what the stat is for you to regain your life after a divorce, but it is nasty, right? Going for a two-income family, splitting debt, being a single income persona with kids and all that mess there. We need to be angry at these institutions. They don't see this on their commercials, right? We just get excited. Oh, look at that. They named a soccer stadium with the $512,000 that you paid. And if you want to look at legacy, look how your parents were treated. Look at the doubling effect of the years that your family's been in this country. I'm getting too passionate. We need to change the screen here and keep going. So, a strategic financial analysis, make sure that you see this. So I've been to 4 banks and 2 credit unions over the last 2 weeks as a fictitious person. I sit down with them and I want to look at their financial plans. And the first thing I want you to know, they have no cash flow analysis. And the reason why you don't see cash flow analysis, you just see budget opportunities, because they don't want you. This is how, it's brilliant, but it's so nefarious. They want you to look at numbers because they know you're going to get lost in the numbers. This is an actual client of ours, by the way. Okay. And so this family, for the very first time, looked at their life, and their life said, oh my God, that's a lot of taxes, right? That's a lot of debt. And that's just a lot of spending to live. And to give you clean insight, we're not going through this, right? But we want people to see in that pie graph, this is what those institutions did to you. They knew this. Now, that doesn't mean the person at the bank is, the devil with the hooves and horns. The bank is, but that person is just a salary employee doing what they're being told to do. And so they do what they do, right? I used to call it steak and beans. You get to eat beans, but they eat steak, and they're not going to give up the steak, right, to eat beans to give it to you. But this is a great point. And this is a family that we took from, becoming debt-free in 2049, and we're able to get them debt-free in 2041 and out of their mortgage, everything 8 years earlier. This is a kind of before and after presentation that we do to that person as that question, completely and utterly, mathematical. So it's like, what do you want? You want to stay the big red and no green? Or do you want to move over where the red is reduced, from $29.96 to 21 and change? And now you got $1,500 a month going into RSPs and going into TFSAs to ensure what your priorities are going to be. Could be buying a house, could be retirement, could be educating your kids, whatever it is. It's important that you have the green and no longer the red. I'm sure you can agree with that. Let's move along. Right. So now we're going to talk about wealth management and the industry there. So the biggest thing that you're seeing on the television, if you watch the Super Bowl, even for the halftime show, you probably saw some Questrade, some Wealthsimple, and some ETF companies, right? So we're going to talk to you specifically about management expense ratios. This is wealth management, and this goes through banking. This goes through, independent wealth management. This goes to insurance companies, again, high level. So the complete management expense ratio that you pay, all right, is taken away from your return. So if you are unaware, ETFs, like those that you can get at Questrade and Wealthsimple and us, right, have a lower fees than the other mutual funds and other fees out there. So I'm going to say to you that if you were to come to our company or you were to go to Wealthsimple, you're going to get charged 90 basis points. That's 10 basis points or 10% under 1 full percent. The average person in a growth mutual fund today is paying roughly 2.25%. The average person in a growth fund today, in a segregated fund, which is a mutual fund, just so you're aware, in the insurance industry, and you're going to pay between 2.25, right, to up to 2.75 as a management expense ratio. What I want to explain to you in no uncertain terms is how that erodes your long-term growth to your priorities, first and foremost. So if you look at a balanced fund, and that's a balanced mutual fund right now, and you look at a balanced fund with us, and it's the same 6% growth, right? And just the difference between 2% is what we're showing here and 90 basis points, all right? Then you're looking at roughly about $125,000 of missing opportunity at retirement. So what does that mean? Well, you could have retired a couple years earlier. If you're going to retire at $50,000, $60,000 a year, and you've got a pension or CPP with you, right? But my point is this is not even completely mathematically correct, because what we didn't add to this chart is what was the lost cost of working with a fund manager. And so I'm going to give you an insight to that. When you have a mutual fund, there is a portfolio manager that works with that fund. And this is important for you to understand. Every article that you're going to research on Google when I'm done will show you unequivocally that 88% of portfolio managers that work within the portfolio management world, 88% of them cannot beat the indexes, meaning the New York Stock Exchange, right? The TSC, the S&P 500, right? Just for names that are recognizable. And that's why companies like Vanguard that we use, and Purpose Investments that we use, and IROC, just, BlackRock iShares that we use. These have been pension fund opportunities for years before the commercial side of using them in the marketplace. So it's even a huger number of differential, right now. And so we believe in the ETF portfolios. They're the lowest cost, lower risk formula for average ordinary people. And depending on your savvy and your risk tolerance, right, we can look at putting you into programs that are more aggressive. But at the end of the day, I went to the banks, right? I sat down, I asked for an ETF portfolio, and at the Bank of Montreal, and I said, what is the cost here? And they said 1%. And I said, wow, that's solid, 1%. I thought, my goodness. Then I went through the paperwork and found another 1.25%. I asked her, what is that? What's this other 1.25%? And she said, well, that's the cost over here of using those ETFs. This is our MER. So I added together. So you're charging me 2.25. And I didn't want them to know that I was a CEO of a financial company. And, and I was angry. So you tried to hide that on me. You made me think that you were almost the same cost as a Quest trader. You're almost the same cost, as a Wealthsimple, but you're not. You're charging me over 2%. You're as bad as everybody else is. You know what the lady said to me? She got emotional and say, hey, I'm really sorry. I was in the mortgage business, up until 3 months ago. I just got fund licensed. How is that my problem as a consumer? How does that land on me? See, folks, if it was you at that desk, you would have paid the 2.25, right? That's why this opportunity to talk with us and to see what we're doing is so important in a lifetime. So the other thing I'm going to add to this little caveat here is that in the insurance industry, they tell you that seg funds are guaranteed. Well, the guarantee is that you don't understand what's guaranteed. So here's what they do. They take the difference between that 2% and that 2.5%, and they self-insure the lump sum you put in there. See that big difference between the blue and the pink? It'll be double that size, right? If you had a seg fund in the insurance world, and you literally self-insure that yourself. Not even, right, the amount of money you've lost by not having it grow. So anytime somebody tells you it's guaranteed, okay, you are paying for that guarantee in the insurance industry. And at the end of the day, would you rather have $375,000 in cash, right? Or would you rather have, right, roughly $175,000 in cash, which would be the difference between an insurance seg fund investment and an MER, right, that you can get with an ETF, electronic traded fund. Next, please. Any questions that I should be answering, Natasha, before I hit insurance?
We've got a quiet bunch today.
Okay, well, I must be doing a good job. I hope that's the reason. So
well,
earlier I spoke about, the average debt frame in this country. And so I'm a father of 4 kids, and they're pretty much all grown up. And if they're not working, they're in school right now. So my liabilities aren't where they once were. But at one time, right, I had 4 children under the age of pretty much 8. And, the loss of my income to the family would have been completely and utterly devastating. And so this is a huge pet peeve. And so I want to make sure, first and foremost, we understand what insurance is for. Okay, we buy insurance, right, to insure ourselves or whatever we've purchased, that if we lose it and we don't have the money to replace it, then we should have insurance. And I alluded earlier to house insurance for flood and fire, or car insurance should you get in an accident, right? And so the same thing needs to work with life insurance. But I want you to know that the life insurance industry has to pay for commission distribution. And because of that, right, there's very little value from a consumer standpoint up until recently where we have brought to market the very first income replacement model in Canadian history. So I'm going to go through this as simply as I can. So I'm going to pretend that right now that I am a 35-year-old, $80,000 earning persona in Ontario. So my marginal tax rate on my $80,000 of gross income is $5,500 a month. Very simple, right? Make 80 grand a year, take home $5,500 a month. If right now you're saying, I don't take home $5,500 a month, I'm not taking, that's just my marginal tax rate. I'm not taking any money away from group planning or RSP matches or anything that's going on in the company you work with. But if you're in Ontario and you only make 80 grand a year at this moment in time, you're after marginal taxes, you'll be sitting somewhere around 5,500. Maybe I'm off by $100, but it's just high level education right now. So if I was to get hit by a bus tomorrow, or my partner was to get hit by a bus tomorrow, we would require to pay our mortgage, our kids' education, whatever my money was used for, or he or her money was used for, would have to be replaced. Pretty simple. In order to replace that $5,500 a month, I need to buy $2,150,000 of term insurance. Why I chose term insurance right now is because every legitimate third-party consumerist will tell you to buy term insurance because it's dramatically lower cost than cash value insurance, which is like whole life insurance or universal life insurance, which combines a savings and an insurance component together, right? So based on a 35-year-old, right? If you're gonna want to insure yourself, you're gonna have to buy 30-year-old flex term or term plus or Le Capital's term pure to cover your life from 35 to 65, which you think about it is the perfect amount of time to cover your life with insurance. Why? Kids are young, right? You're in debt, not saving a lot of money, right? You know, so you need that chunk of insurance to cover you, right? Think of it as your car. If you bought a brand spanking new Honda Accord today, you'd fully insure it, right? 30 years from now, and it'll probably still be running because it's a Honda. It's not going to be worth the same money it is today. So you should not cover that amount of coverage on it. So here's the cost. If you want to pay for that, right, you're going to have to pay between $215. These are the top in Canada for a 30-year term. At SSQ, it's about $216. At La Capitale, it's $218, right? But here's the problem. That money then has to go inside of an investment. That investment has to give you a rate of return, which is not consistent. Why? Because markets go up and down, all right? And so in a low market, like we've had the last 2 weeks, you'd have to take out more money to get your $5,500. And a high market, like we had a bull market for the last 10 years, you probably take out less money. The point is it's up and down, and you're going to be taxed on the investment. So the investment will have to be put into something that's more tax incentivized, like dividend and income funds, which is fine, less taxes, but less growth. So you have to take more money out to offset the taxes from that standpoint because you're not growing like a growth fund. At the end of the day, there's your cost. There's the downfalls. This is why the majority of Canada does not have the right amount of coverage. So what we did is we said, let's not have commission. Let's take out a giant chunk of cost, right? Let's work in mathematics and let's give that family, okay, a $5,500 a month payment, just like if the breadwinner was alive, which will take care of that mortgage. You don't even need mortgage insurance anymore. You don't need any outside coverage. And that will pay that monthly payment right away to 65. So all your RSPs matured just like you planned. You paid for your daughter's or son's wedding just like you planned. They bought a cottage even though you weren't here, right? Just like you planned. And we always make sure there's a final expense coverage of $100,000 for expenses of the year of death. The cost of that is $146 versus what you just showed on the other side. So once again, just like, right, Jenny Craig, which I love the way they sell. A, this is what you're going to have to pay, or B, here's what you could pay. And B actually ensures your financial plan, not just your life. It should not be called life insurance, right? Nobody ever gets anything living, right? If you die, your family gets paid. It should be called, right, life income insurance. It should never be called, right, life insurance. They should call it death insurance, but you don't get a lot of sales on death insurance. We're going to do a follow-up to insurance alone, which is another complete talk I'll give. But right now, right, if you're not covered to replace your income, then your family's liabilities are not covered. And that's the number one effect. If you've got great group insurance, no problem. Part of our mathematical engine is we will analyze your group program and we ensure that you maximize it, because normally group insurance is what we call the lowest cost per thousand of coverage. So if there's a way through your group plan or your guild or whatever you belong to, no problem. We'll ensure that that is part of the mathematics within your world. So just on a quick recap here, right? We talked about banking and debt and how that works. We talked about wealth management and managed expense ratios and how that works. We talked about insurance basically and how insurance works specifically in the life insurance world, because these are all things as young families or young people that you're probably going to be working with. If not today, then definitely at some point in your life when you choose to have a life partner and share your life and move forward as a family, that will happen for you. If you don't, it's still part of your life, because you're still going to have to handle, right, getting a mortgage. Here's a great point. Why after Dr. Moshe Levesky has wrote a 50-year paper on variable rate mortgages versus fixed term mortgages, why do 65% of Canadians at the bank getting their mortgage is fixed term? When we know mathematically, and it's been proven irrefutably, that variable rate mortgages in the last 50 years in our country beat out fixed term 48 out of 50 years. So I want you to know why, because they will con you to say it's your first house. Oh, you're not used to these payments. You need to make sure it's one payment a month. And then I'll add to that, why is it that all those fixed term, all those fixed term mortgages, right, aren't paying bi-monthly? Because they want all the interest. They don't want you paying down interest, right, twice a month. They want to make their shtick every single month. This is unheard of. There's no mathematical solvency whatsoever for banks doing that, other than the fact that you can sell as a derivative, we're not going to talk about today, a big chunk of fixed rate mortgages, right, and earn and replenish and do it again. So we've got a situation here, folks, where our clients are going to become crusaders. Our clients are going to know the difference between the mathematics of the institutions putting their thumb on people, right? And force them into making bad decisions. You look at it right now with inflation, we're expecting to have gasoline go to $2 a liter within the next 90 days. How are we going to handle that? If you were used to paying on average $1.10 and your gas cost was like, maybe $200 a month, now it's $400 a month. And you're used to spending X on your mortgage, and now it's jumped up, right? An extra $1,000. Where does this money going to come from? It's impossible, right? It's not mathematically solved to do that. So we designed an engine to start teaching and working with people. So here's what we did. Next, please. Right? We made it easy to use, right? You have your own dashboard. You've got yourself, right? Whatever your priority was. Your priority was investing. Your priority was debt, insurance, mortgage. You just click on your button and you see where you're at on a live, breathing, right, engine working with your finances on a daily basis. If you need to talk to somebody, we built a video platform for our money coaches. We call them money coaches because we coach people. If you're going to say, hey, I want to spend this, we're going to tell you if you spend that, that's what's going to cost you against your priorities. So what are you doing? Are you changing your priorities? Unlike the financial institutions out there where they don't care, right? As long as they get their commission, as long as they get your debt, as long as they get their managed expense ratios, they couldn't care what you do with your life, but your life is everything. And let me help you out. I don't care what book you read on creating wealth. There is one thing that everybody states. Creating wealth is about habits. And that means if your wealth is building, right, and owning a home, great. You need great habits for that. If it's getting in a debt, you need habits for that. If it's saving for your kids' education, they need habits for that. And I think somewhere along the line, we forgot how to, right, work with these habits. And that's how we got to $1.74 for $1 earned. So we made it simple. This is what it costs you, or this is what it costs you. What do you want to spend more or spend less? And so we did this in an entire holistic environment, because at the end of the day, you can have a great financial plan, and there are some out there, but if you don't have the products matching the plan, you're still getting hosed. If your MERs are high, you're still getting hosed. If you don't got a great plan, but a financial planner with an insurance license sold you on insurance products, you're getting hosed, right? If you went to the bank, you're getting hosed, right? And you say, well, John, are you the only guy who's not hosing people right now? Right now, we're the only ones. We're the only ones with the math to prove what we're saying 100% of the time. Take the challenge and see what we can do. But this whole time with you was to educate you and make sure that you're not alone, that there's an actual company out there that's taking a stand. Right now it's Gorilla, but sooner or later, right, will become one of the biggest brands out there. Our board holds CEOs from a credibility standpoint. We're working with companies that have over 100 years in our country, the biggest names in wealth management. So there's no problem with us and our engine, because we put you in front of everything that we can. On the mortgage side, we even take the bank rate and we buy it down lower than what they can do for your financial plan, right? And we've got a program we're putting in place for first responders and military people who choose to swear their oaths and protect us in all ways of life, to help them out a little bit more, because we think that they require it because of the risk that they take. We're not becoming a great company because we got great software. We're becoming a great company because we're listening. We want to hear from you. After this is done, please follow up with us. Tell us what's bothering you right at your bank. Tell us what's bothering you with your insurance. Tell us what's bothering you in any aspect of finance. And more importantly, what do you want to see on a dashboard? When you wake up in the morning, right, and you have a look at your life, not LinkedIn, not Facebook, not Instagram, your life. What do you want on your life dashboard? How do you want us to track it? Right? What do you want to see on it, right? And what calculators would you be interested in? And so we want to create this for you. We're taking a lot less than other companies, but we feel that this generation is probably the greatest generation that we can work with, who is searching for mathematical empowerment. And this empowerment that we've created for you via Dr. Moshe Milevsky's inspiration, his book, is going to change your family's legacy moving forward. No more will those banks have that on you. No more will you pay those high interest rates that you had in the past. No more will you be skewered with management expense ratios or end up with a mortgage, right, that you have to pay twice the amount of interest over a lifetime, and all you needed was a variable rate and a biweekly program. That will not happen to you at Wealthy Planet. We believe that every single consumer out there should have a level playing ground, right? We also believe that every democratic country out there should have that level playing ground. No more will we say stupid things out there like the rich get rich and the poor get poor as middle income pays the taxes for everybody, because it shouldn't be that way. And the only way that we're going to empower ourselves as a company, by empowering you. So I'm open to some questions right now, and hoping that maybe I've stirred the pot somewhat to how you feel about what you've been through, and maybe I can answer a question for you. Otherwise, thank you very much.
So I'm so glad to hear you're open with questions, because we had a bunch come flooding in after the last time you asked. So one of the first questions we got was when you were going over the MER is, it looks like we need some clarity around what's a MER, what's your portfolio?
Okay, so an MER is a managed expense ratio, and I would say that is all expenses into one, right? So you might have part of that as expense ratio. An advisor has an advisory cost on it, right? And here's why. They might be picking up a product from the market that has got a wholesale cost to it, and then they add their commission to that wholesale cost. One of the big funnies out there today is, I'm a fee for service financial planner. I only charge 1%. Okay. Well, that's great, but you still get your commissions on anything else you do. And if you can pay less than 1% and get more, I suggest you do that. And that doesn't mean to us. That means to going to companies out there like us. You won't get the planning tools, but at least you get the product. So that's managed expense ratio. So we charge 90 basis points. So there is 100 basis points in 1%. So 10% less of one would be 90 basis points. You might recognize yesterday, they said 25 basis points was the increase in the prime rate. So that was 1/4 of 1 full percent. So we pay. So the charge that we carry is the same charge that you'd get, from Wealthsimple. The end of that question is, what do we have as investments? So we specifically use ETFs. A great reason why is you just watch the bouncing in the market. If you're a stock-based portfolio, again, the odds are 88% of people who are managing those portfolios aren't beating the indexes, meaning their group of stocks they have in their mutual fund or their seg fund or whatever it is not competing against the indexes. They can't beat the S&P 500. If you want to have a great look at that, go to the Morningside website, and they own Andex now, and look at an Andex chart, ANDEX. It's the economy for the last 50 years. It shows you what's done well over the last 50 years. It breaks down everything. It's a great piece of information for you to look at. Maybe what we'll do is send you the link to that as a thank you for just joining us. So the last part of your question is, what specifically investments? That depends on your risk tolerance. So you do a mathematical questionnaire, and we get a risk tolerance from you, and we put you in a portfolio that matches that risk tolerance. So for example, if you've never invested in your life before and you'd have started 90 days ago, and if you were in a growth portfolio, you'd probably be pulling your hair out right now because you went from about 2 months of good times at a bull market that was just finishing off, and then you went through a cataclysmic issue with the invasion of Ukraine. And if I said to you, look at that index a little while ago, if you look at the index and go back to 2014, you can see what happened in the marketplace with the invasion of Crimea. So my point specifically is this: you'd go crazy. So odds are you'd probably be put into a more balanced program right now. And then as your confidence grew in the marketplace and your portfolio grew in the marketplace and you chose to learn more, if that's what you want, then you could upgrade your portfolio moving forward. And we do that same way mathematically. So we ask questions like, if you lost 10% in the marketplace, what would you do? A, sell and go to more secure investments. B, invest more money. C, so these are the kind of adaptive questions we'll ask you, and then we'll get a numeric number to assign that to a portfolio. But just be aware that we have the ability to create any kind of ETF with our wholesale where we get. So Vanguard and IROC and Purpose and all these companies, right? We can customize a portfolio for those of you that you feel you're super savvy. And, and then some of you are right. Maybe you do your own trading. And I always get those kinds of people. So here's what I'm going to say to you. For your own RSPs and your TFSAs, you need to be vanilla. Here's why. If all the fund managers, right, who have gone to universities to become PMs and become masters of finance or actually have doctorates of finance and economics, right? If they cannot beat the indexes with their modern, if you will, theory of investment, what makes you think you can? Oh, that means you didn't hit a couple of good weed stocks back in the day or a couple of growth stocks here and there. I'm talking 30 to 40 years of you growing your money. You want to use your play money and do the penny stocks or mining stocks, whatever you want to do. Absolutely. Have fun. Enjoy yourself. But for your core retirement, right? If the professionals with all the education and all the work and all the analysts that work for them and all the travel and every continent on the country can't beat the indexes, what makes you think you're that special that you can? You need to make your RSPs and your TFSAs. That's your cement. That's your floor before you build as you go forward. I hope I didn't make you angry, but that's the truth. That's pure mathematics, and if you're that special that you've got that great a period of time for 20, 30 years, well, give us a call. We'd love to see what you're doing because I haven't seen it in the 30 years I've been in the game. So hopefully that helps answer your question.
All right. Seems like there wasn't a follow-up to that, so I hope that answered your question there. I just wanted to remind everyone that if you do have any questions after the webinar that you didn't get a chance to ask today, or you're mulling all the information over, we will be sending out a survey. So if you have any follow-up questions or any feedback, keep an eye on your inbox and spam box so that we can address anything that maybe didn't come up in the webinar. But John, we have one last question, and then we will be doing the draw for the $150 gift card. So our last question is, why in the current inflation and climbing rates, the variable rates are still better than the fixed rates?
Okay, well, I'm going to try to give a high-level answer to that. So fixed rates are based on the bank reselling that book of business. I kind of mentioned of it earlier, whereas variable rates, all right, are based on a futures look. So So the bank is saying we're going to sell X amount, right? We're going to put $2 billion at a rate of 3.75 over 5 years, right? And they can resell that in the market very quickly, and that will get bought up because, you know, in the world sense, in the high level sense of business, right? You know, there are people who are gonna buy that rate back in a derivative and maybe even resell it again, you know, because it's a Canadian insured book of business. In a variable rate mortgage, right, you are hedging against the future. And so it will never be as high as a fixed rate. In fact, the only time it happened was when the prime rate was literally 14%, meaning mortgages were sitting at 16 and 17%. And I know I was there. I bought my first home in 1991 and I got a 12% mortgage rate. And I thought I was the winner chicken dinner because it wasn't 16% like it had been a few years. It was the only 2 years that this country's ever had that hyperinflation. There are now, if you will, stopgaps put in place that can't happen. You're seeing it right now where we now can balance inflation with interest rates and ensure that we slow down things. You know, unfortunately, the housing market takes a kick in the teeth to that, but it's not like it didn't require it, right? When a young couple has to go into a home or a townhouse at over $1 million, how do we keep moving forward as a country doing that? That is absolutely impossible. No time in our, you know, history were we able to leverage that kind of debt and that kind of cost of housing and effectively move forward. So I tell you what we'll do is it's a good read. And Natasha, I think we should send whoever asked that question and whoever is on the call, let's send them the paper. You know, it's a great way for them to be empowered and look at it. I try to give it a high level understanding. At the end of the day, the banks make more money with a fixed rate, right? It's boosted for more profit. So both on the front end over those 5 years as the sell off later too.
Absolutely. We can make sure everybody gets that literature afterwards. I don't see a specific follow-up question there, but again, there will be the ability to send in questions after the webinar if anything isn't addressed and you would like some of your questions answered. So without further ado, I will start my video. And so how we are doing the $150 gift card, just to keep it fair for everyone, we have used a random name picker. I had to put anybody's name who is attending the webinar today. And then I let a computer run that and just pick one at random. So
no balls floating down the machine, right, for the lottery?
No, but you know, maybe in the future we'll have a little VR one that makes it seem like there's that going on, but it is all just numbers. And the computer picked Thomas is our lucky winner of the $150 Visa gift card. So congratulations to Thomas. We will be emailing you afterwards so we can coordinate getting that to you.
And he's probably going to spend that all at the gas station, right? Because I can't believe what's going on out there.
Try to spend that at a gas station. You're going to be splitting it over. I've got the one gift card and then, you know, I'll do the next on my debit. But
I just have one last comment before I sign off, Natasha. I would like to challenge anybody that watched our program today to go and get another financial plan out there and come back and compare it to us. Because, you know, I remember somebody challenged me 35 years ago and said, how good could you stand your life? And I didn't have an answer for that because I didn't understand how life, you know, 35 years ago could become that much better. But I didn't have any mathematics to look at either. So my challenge to all that are watching, how good could you stand your life to be? Go get whatever you have and bring it back to us and let's analyze it and let's show you what we can do. And so if we can make your life better, it's a pretty simple decision, right? You know, I think you're going to find out that as time moves on, we're that unicorn in the financial services space with the tech and the feel and the storyline that you'll be proud to work with, because at the end of the day, we built this all for you. This is all created for you. We've spent millions of dollars so that you could have a better life. At least give us the testing that we've earned and deserve, because how good could you stand your life? Bye, everybody.
Thank you so much, everyone. Have a great day.